All right, now as housing affordability tightens, more first home buyers are turning to their parents for financial support. But while much has been said about the bank of mum and dad giving their kids lump sums of cash for a home deposit, another trend that's not talked about as much despite its popularity is that of the many Aussie parents choosing to go guarantor on their kids' mortgages. Now, one mortgage expert is warning parents to think carefully before agreeing to become a personal guarantor, especially on home loans. And that's the CEO and founder of Finch Financial, Julian Finch. G'day, Julian. Welcome back to the Savings Tip Jar.
Good morning, gents. Good to be here.
It's good to have you back, Julian. It's been a while between drinks. You were last on in episode 34 in September 2023. For listeners who want to have a bit of a trip down memory lane talking about fixed rate home loans at the peak of interest rates, that's well worth a listen. But before we launch into guarantor loans, do you have a savings tip for us?
Yeah, look, my savings tip just comes as I'm about to renew my car registration is to ring your insurer and get a discount on all those insurance policies you got, whether they're car or house and contents or even health insurance. I've undertaken this exercise myself over the past 12 months and saved about $6,000 for the whole year just with a couple of phone calls. So not only can we save money on our mortgages and interest rates and things like that, but definitely on other financial products like insurance, etc.
Great savings tip, Julian. Yeah, we haven't heard that one before. And that's certainly something we don't really think about. Well, I don't think about too much anyway when I'm just paying my rego. You just take it as a given. But of course, CTP insurance is included in that registration cost. And you don't actually think that perhaps maybe you could get a better deal on your CTP with a different insurer, particularly if you've got a whole bunch of policies all with the one insurer. Maybe they're more likely to give you a bulk multi-policy discount. So that's a good one.
Well, people fall foul of the old pay by the month, you see, and so it's an auto renewal. It's just easy to keep going, but it's well worth a look at least once every 12 months.
Yeah, that's absolutely right. Now, guarantor home loans. Obviously, you're warning of some of the risks and dangers there. But firstly, I just wanted to ask you, how many people actually are taking out loans with their parents as guarantor? Is it quite common?
Yeah, look, it is quite common. And I guess I point out the risks in the sense that, people obviously need to make a very sort of considered decision when they're doing this. But of course, when you're helping out your kids or you're asking mum and dad for some support to get on the property ladder, it's a very, very effective way to be able to do that and can be quite well cost effective as well. So risk definitely, but certainly it's not uncommon and it's quite easy.
Yeah, before we get into some more of the risks, it's certainly something I've noticed among friends and family. It's like, oh, how can you afford that house and you're 23 years old and you don't have much of a deposit? Lo and behold, they've used their parent as a guarantor. What are some of the other sort of benefits of using a guarantor?
Yeah, look, so I guess you made mention in the intro about sort of lump sums of cash from the bank of mum and dad. Well, I mean, this is an effective way that you can actually, support the deposit. I mean, if we're talking a 20% deposit on a $500,000 property, it's $100,000 that you don't actually have physical cash for, and nor do your parents need to provide $100,000 in cash either. I often sort of think of it as like they're giving you the use of their spare bedroom so that you can go and buy a property. Obviously you can't carve off a bedroom off mum and dad's house and send it to the bank, but these limited guarantees, which are the technical term, I guess, for a family guarantee or bank of mum and dad, the limited guarantee gives you that opportunity to use part of the parent's property to secure your loan.
Now, Julian, it sounds like the decision to go guarantor isn't one to be taken lightly. Can you tell us of some of the dangers and risks that people need to be aware of before signing on the dotted line?
Yeah, so I guess it's important to be able to differentiate between the guarantees that you're signing up for. So, excuse me, the limited guarantee, which we're talking about here, is probably a lot safer than the types of guarantees that might have been in the marketplace 20 or 30 years ago, and they're certainly different to the ones in the marketplace when we're talking about commercial lending and things like that. So in this particular instance, limited guarantee is limited to the amount that you're offering to guarantee for your family member, let's say. So in that sense, if you're borrowing $500,000, you need $620,000 worth of security. And so at that point, your property that you're buying is worth 500 grand. We need 120,000 from mum and dad by way of security. And so they're signing on to only support your loan for that 120K. Now, one of the risks to consider, of course, is that, well, if things go wrong and my child can't pay their debt, well, what's the worst thing that can happen? Well, the worst thing that can happen is the bank's going to come after me for that $120,000. Okay, now the important thing to remember though is that the borrowing amount is still only the 500K, right? So if they can sell their property before things get too silly, and I say silly because, it's a long way from start to finish with someone sort of repossessing your home. But if we can sell that property and repay the debt in full, then of course the guarantee can be discharged and there's no need to call on it. But you should always take a view of what's the worst thing that could happen. And in this particular instance that we're trying to explain here, mum and dad could be up for $120,000 as a maximum because that's the guarantee they've signed on for.
Yeah, for sure. Now, if someone's done their due diligence, they've had the potentially awkward cap in hand moment to their parents, asking them to go guarantor. What sort of lenders are better to deal with in this regard? Because it was actually a surprise for me to learn, and I think it was through you actually, through reading one of the comments you made for our journalists on our guarantor loans piece of content that we wrote recently, was that not all lenders allow you to have like the guarantor's home loan with another lender, whereas some are a bit more flexible in this regard. So who are some of the better players to deal with if you're looking for a guarantor home loan?
Yeah, look, the two that I would go to first are St George or Westpac. So I count them as one because they're owned by exactly the same policy. And the second one would be the Commonwealth Bank. If we're talking about other majors, ANZ do a guarantee loan, but I think you've got the guarantor has to service their portion or the guarantee amount. So CommBank and St George / Westpac, no serviceability required on the guarantor's behalf, and both of those lenders will go second mortgage behind a first mortgage lender. So for example, mum and dad might have their mortgage with Suncorp, CommBank or St George. You're happy to go second behind Suncorp as long as they can validate the value of the property and also validate the level of mortgage held at Suncorp. So there has to be still equity available to call on in the second mortgage situation.
Now, Julian, obviously the government has effectively a guarantee scheme of its own in the home guarantee scheme, which is effectively the federal government going guarantor on people's mortgages. I wonder what's the benefit of getting your parents to go guarantor rather than going through this home guarantee scheme, of which the eligibility criteria were recently quite extensively relaxed to allow effectively any first-time buyer, no matter their income, to qualify for it. So, with everyone being able to qualify for the federal one, why would you go with your parents as guarantor instead?
Yeah, look, I suppose a couple of reasons. So the federal one, that's for owner-occupied property only. With the other one, you could be a first-home buyer, but you could be an investor. So you don't necessarily have to live in the property. The restrictions, if you like, have been relaxed markedly. In fact, they probably only come into effect in January 2026, to be honest. But so at the moment, there's a $900,000 spend cap on a New South Wales metro property. In Victoria and Queensland, it's slightly less. Around the country, again, it's a different cap for each different state. And then, of course, you've got regional caps as well, which are considerably less than the capital city amount. So, for example, in New South Wales, a $900,000 cap in Sydney, but if you sort of in the Blue Mountains or maybe a bit further west, it might be down at $750K. So there's still property restrictions there in terms of the value. When you're getting assessed by the lender, you might have, if we took a $900,000 purchase in Sydney, you only need $45,000 in savings, right? That's the 5% deposit. If you've got $150,000 in savings, the bank wants you to use probably $120,000 of that money. So you don't have the choice. It's like, well, I've got $150,000 in savings, but I only want to spend 45. The bank's going to make you spend 120, and they'll give you 3 months up your sleeve, right? With mum and dad, of course, you can keep all your cash and put that in offset or leave it as a buffer for maintenance or anything that might pop up unexpectedly. And of course, the other hurdle that you've got to pass, you need your most recent year's individual tax notice of assessment. So for the current, we're in end of July, we've got until the end of August at one lender to provide the NOA, but some places right now require the NOA before they'll even assess your loan eligibility for the scheme. So there's a few hurdles throughout the year that you run into from a tax perspective, and of course you need to make sure as an individual you've earned less than 125k for the previous year, or $200,000 as a couple. And look, sometimes the house you want to buy, that type of income doesn't cut the mustard, unfortunately. So if you're using mum and dad as a guarantor rather than the government, then you've got a bit more flexibility in the type of income that you earn and things like that. So,
yeah, for sure. I guess it all falls back to the property price caps on that type of scheme. Good luck finding anywhere halfway decent in Sydney for less than 900k. And then as well as that too, I think you're right in the sense that that banks, when you're using the home guarantee scheme, they don't want you to have any leftover cash. They want you to tie up all your savings in that house deposit. And you might want to keep some aside for a rainy day. But yeah, you might be limited in that regard. My next question for you, Julian, it might be more of a sort of lifestyle question. And you might have been aware of, some of the better scenarios that you've dealt with in the guarantor land. There's been a young first home buyer and their parent come to you, say, hey, we want to go guarantor. How do the best sort of scenarios make it work? And how do these arrangements, how can you avoid awkward conversations at the dinner table if someone is considering a guarantor loan?
Yeah, look, I guess it's important to understand what questions you're asking if you're at the dinner table, but also making sure that your parents understand as well, because sometimes I guess the conversations get a little bit lost because people don't know necessarily what they're talking about. I mean, it's one of those things where I might suggest it to a client and they're like, oh yeah, I'll ask mum and dad, and then they come back and say, oh no, they weren't up for it. It's like, well, why not? What happened? And I suppose there's other things to consider. You might just be a bad kid, right? And your parents think, nah, stick it up your jumper. But I suppose if you're going to go and ask mum and dad for some help, you probably need to have displayed some good behaviours before that conversation, where if you're out every weekend on the drink, spending your money at the TAB or something like that, and you're constantly asking them for $50 for lunch, then they're probably not going to be so keen to stump up, $100,000 guarantee so that you can go and buy a house. I mean, I guess these things, they take trust and they take a little bit of effort to make sure that the relationship works well. And look, I think 9 times out of 10 or 99 times out of 100, it's going to be okay. But yeah, look, if you've not been so diligent in the way that you manage your personal finances, it's probably going to be a stretch to get mum and dad on board. And then, I mean, they're the easy ones to convince, right? Once you've got them in the bag, you then got to go and present your case to the bank to say yes. So I think, treating the whole sort of plan and conversation around how we best going to process, important to show the good behaviours in the lead up to the conversation.
Now, just a quick final one, because I know we've gone a bit over time, Julian, and we appreciated all your time on this one and insights. Can you, once you've signed up to be a guarantor on your son or your daughter's mortgage, can you actually remove that, like pull that guarantor arrangement off of their loan? Because I imagine, what if that son or daughter, took out a home loan with their partner, and then it turns out their partner was, cheating on them or whatever, and they break up. I could understand if you naturally probably wouldn't want to be the guarantor on their ex-partner's mortgage now. So is that something you can get out of easily?
Yeah, look, it is. So I guess two things there. The first one is it's another episode to talk about family bust-ups. But the second point, the most important one to directly answer your question, is very simple to have the guarantee discharged. One of two things. Either you've paid the loan down so that the LVR, the loan to value ratio, your security stands on its own. So that might be a revaluation in 6 or 12 months' time. You've paid the debt down to a level where the debt versus the property value. So it can sort of work in two ways, where you're paying the debt down and your property's going up in value. Sometimes you can find us quite quickly able to discharge the guarantee. So I reckon I've had it done in the past where within 12 months you can get rid of mum and dad off the hook, if you like, and they can carry on with their life, and you can stand alone on your own without their guarantor anymore.
There we go, Julian. Always have an exit strategy, I suppose. Full-time broker, part-time family psychologist. Thanks so much for joining us on the Savings Tip Jar podcast.
Thanks very much.
Cheers, Julian. Thank you very much.